Hey everyone, Richard Norris here, and welcome to a brand new episode on my channel. In today's video, if you're a property entrepreneur and you're looking to maximize your tax benefits and minimize your tax liability, then in this video today, I'm going to show you how you can incorporate your privately owned property rental business, wash out your capital gains tax bill, and basically unlock huge tax savings for yourself. Now, just before we go into today's video, I really want to, basically give you a broad disclaimer. Look, I'm not a tax advisor. I have no tax qualifications. And what I'm sharing with you in this video today should not be constituted as financial advice or tax advice. And what I'm sharing with you is my own personal knowledge and through my own personal endeavors, should I say, of having helped clients in these situations understand what they can and can't do, having looked at the HMRC code of manuals and under HMRC's guidance, what you can and can't do as a property entrepreneur when it comes to incorporation. But like I said, as you go throughout this video today, my goal is to impart wisdom and knowledge on you about how all of these things work, because I am the founder of a company called propertyconsulting.io, and we do help clients in this situation, and we outsource the work to people who are qualified accountants and tax personnel and legal personnel to be able to help property investors to incorporate their property portfolios. It's a very nuanced situation. It should be done bespoke to your individual parameters. It's not one size fits all, so do not take any of this as advice in today's video. I just want to kind of get that out of the way. But with that being said, many property investors will incorporate their property portfolios for a number of reasons. And one of the biggest reasons why a property investor might want to incorporate their privately owned property rental business is to basically get away from Section 24 finance restrictions, which basically was a punitive tax legislation, which really kind of meant that if we owned property in our personal names, we could no longer deduct our mortgage interest. It wasn't an allowable a tax deductible expense, and we had to get a 20% relief on the annual mortgage interest allowance. That was the main reason why people started looking at incorporation. Now, one of the other reasons why people look at incorporation, one of the major advantages of incorporating your property rental business is you can actually defer your capital gains tax, or in some cases wash it out completely. And it's otherwise termed washing out your capital gains tax. Now, a lot of landlords that I work with, they ask me, so what does incorporation relief actually mean, and how do you actually wash out your capital gains tax? Well, in this video, I'm going to allude to exactly how you can do that. I'm going to talk about what it means in simple terms using an analogy, and then I'm going to talk about what HMRC guidance says, and I'm going to pull up the HMRC manual. I'm going to tell you word for word exactly what it says about incorporation under that specific piece of legislation when it comes to exchanging your net equity in your business for shares, which is how you basically wash out the capital gains tax bill. That's what you do under this piece of legislation and under HMRC's guidance. And then I'm going to go through an example with you, a worked example, to really bring this into fruition and help you understand the mechanics and some of the numbers so you can really understand how this works. Because there are also situations where you may have created what's called a latent gain in your property rental business, and you may not have realized this. I work with a number of property investors that have property in their own personal names, and they come and they don't realize that they've created these massive latent gains over the years. And by not understanding that, when it comes to incorporate the privately owned property rental business, actually they crystallize a tax on the latent gain, and they cannot incorporate the portfolio and wash out the capital gains tax in its entirety and get that benefit because of past mistakes that they've made. There is a video on my YouTube channel which talks all about latent gains, so I'm not going to go into the granular depths of latent gains today, because you can watch that on my YouTube channel after watching this video if that is of interest to you. There's a link to it right here. But I would encourage you that you stick with this video first and foremost and you understand, how do I actually wash out my capital gains tax bill, and what does incorporation relief actually mean? Well, first and foremost, let's dive into the piece of legislation that really governs this kind of transaction, where you can actually get the benefit of washing out a capital gains tax bill on your privately owned property rental business, and under what legislation. So I'm pulling it up directly here from HMRC's website, and the first thing it says CG 65700, transfer of a business to a company, introduction and interaction with other reliefs. Now, the specific code for this type of legislation is TCGA 92/S162, which effectively is another thing that you might have termed business incorporation relief. Now, let's see what HMRC actually says, word for word, their rhetoric on their website about this. So what it says is, it says that TCGA 92/S162 applies where a person other than a company transfers a business as a going concern with the whole of its assets or the whole of its assets other than cash to a company wholly or partly in exchange for shares, provided that various conditions are satisfied. See CG 65710. The charge to CGT on the whole or part of the gains will be postponed until such time as the person transferring the business disposes of the shares. Okay? So it also says here that the way the relief works in practice is that all or part of the gains arising on the disposal of the assets, in this case the properties, are rolled over against the cost of the shares. And like I said, we're going to go through a calculation so you can kind of see how this works in real time. And it says relief under TCGA 92/section S162 is sometimes referred to as incorporation relief, as I alluded to earlier. And it does say that a claim is not required because the relief is automatic. However, the person transferring the business can make an election under TCGA 92/S162A to prevent relief under TCGA 92/S162 from applying. Okay? So what does that actually mean? Well, what it really means is, it means if you own a privately owned property rental business, your own name, and you want to incorporate your property business, what you can do is you can exchange the net equity in the property portfolio for shares. Okay? And effectively, just for your understanding as we go through the video today, there's two things I want you to understand. I want you to understand capital gain. And capital gain is current value minus your acquisition costs. And your acquisition costs are otherwise termed, as a property investor on incorporation, we do something called a base cost calculation. And your base costs are your purchase price. What did you purchase the property for? What were the summation of your purchase costs, which could be stamp duty, land tax when you bought the property, any legal fees that you paid on acquisition, any broker fees and such. And then you have your capital costs, okay? So anything that you've done as a capital cost to enhance the value of the asset. And that has to be like, maybe you spent £3,000 on a kitchen before and you're now replacing that with a £15,000 kitchen that significantly enhances the value of the asset. So it's not to be mistaken for a revenue cost. This is a capital cost. So just to clarify, base cost is purchase price plus acquisition cost plus your capital cost, okay? So capital gain is your current value minus your acquisition costs, which we're terming there as a base cost. And equity is another term you're going to hear me talk about in this video today to help you understand how you wash out capital gains tax on incorporation. And equity is current value minus, in this instance, mortgage liabilities, okay? Now, as long as your net equity is not less than your capital gain in your property portfolio, then you can wash out the capital gains tax bill. If you have an example where your net equity is less than the value of your capital gain, you'll create what we call a latent gain. And like I say, there is another video that talks about latent gains. And so I'm not going to go into the depth of that. You can watch that, but I'm going to go through it in a spreadsheet in a second when I go through a worked example. So in theory, that's what it means. You're exchanging equity in your property portfolio for the cost of shares. So you're exchanging equity for shares. Now, to break this down into simple terms, and an analogy that our tax consultants use, and I think it's an amazing analogy, so I'm going to use their analogy. Just for a disclaimer, this isn't my analogy, it's their analogy. But I think it's excellent and it's a great way to explain it in primitive terms to help you understand this. So let's say that you have a white tiled floor, okay? And it's really clean. And then the white tiled floor gets full of thick mud. And in this situation, the white tiled floor is our properties, and the thick black mud on the white tiled floor is the capital gain that sits in those properties. Well, let's say we now come along with a fresh white towel. And the fresh white towel in this scenario is our shares in the business. And we take the fresh white towel and we clean the white tiled floor. Now what happens is this white tiled floor becomes clean again, okay, which is the properties, and the thick black mud, which is the capital gain, goes into the white towel, and the white towel is the shares. Now the white towel is muddy. It's full of that thick black mud. So we've got the white towel, which is the shares. We've got the thick black mud, which is the capital gain that sits in our properties, but it now sits in the shares, and the properties, which is the white tiled floor, is now clean again. There is no capital gain in it. However, the thick black mud that was once on the white tiled floor sits in the towel, and it's the same. It looks exactly the same. We haven't decreased the amount of mud. We haven't increased the amount of mud. The mud still exists. It's just been moved from a more inconvenient position to a more convenient position. So that's the analogy that I use to try and help explain that to our clients. And again, that is what our tax consultants have alluded to and suggested and termed when they're helping our clients to understand that when they're washing out capital gains tax in the privately owned property portfolio. So hopefully that helps you to understand how you move a gain from your properties and into the shares of a company. Now, with that being said, at this point, let's go into a spreadsheet. I'm going to talk about this and bring some true numbers and true value to it. But just before we go into that spreadsheet, I kind of want you to sit with this because this helps to explain it as well in basic terms. Let's say you bought a property for £100,000, okay? And then you sold that property to the business for £500,000, okay? So therefore, in that situation, we had a £400,000 capital gain. But let's say that the very next day, the company sold the asset for £500,000. Well, of course, if it got introduced at £500,000 and the very next day you sold it for £500,000, so the same value that it got introduced to the company at, of course, there is no gain. So in that scenario, you've washed out the gain in the company, in the property, because effectively you're selling the property the next day for the same that it got introduced on the balance sheet in the company at. Now, one thing that's really important to note, remember this, is you're moving the capital gain from your properties on incorporation into the shares. So you never pay capital gains tax in a company because capital gains tax doesn't exist, right, in a company structure. So after you've incorporated your properties, you won't have a capital gains tax bill. You won't trigger a capital gains tax bill on the sale of the properties because remember, the gain sits in the shares. So it's only when you dispose of the shares that you crystallize a tax gain. But the capital gains on shares is less than the capital gain that you'd pay in your own personal name when you buy properties and sell those properties through your personal name, okay? And I'm going to touch upon this as we go throughout the spreadsheet in a second, because of course, capital gains tax in your personal name is 18% as a low rate taxpayer and 28% as a high rate taxpayer. And then what's really imperative to know and to understand when I go through the spreadsheet here and explain this example to you is when you exchange a capital in the properties for shares, the shares are taxed differently. So yes, there'll still be a capital gain on the new premium share value if you were to sell or dispose those shares, but the lower rate tax on capital gains for shares is 10%, and for a high rate taxpayer it's 20%. So it's still less than 18 and 28%. And remember, when you sell the properties in the company after incorporation, the sale of the properties doesn't trigger a capital gains because the capital sits in the shares, not in the properties, and you'll just pay corporation tax between 19 to 25%, depending on what the profit and loss shows for that year in the company, which you can, of course, massage and control much more effectively. And you'll understand one of the benefits of incorporation and washing out a capital gains tax bill in this way is you can control the sale of your and disposal of your shares a lot easier than you can on your properties because you can gift a proportion or transfer a proportion of your shares year on year and not in its entirety to basically control and defer that tax bill over a number of years, which is much better. So it's much more flexible for you if you have a large capital gains tax bill that has been built up from the past. So let's jump into the spreadsheet to give this some clarity.
Okay, so let's try and explain this and really the mechanics and the mechanisms and bring this to life of how washing out a capital gains tax bill on incorporation works. So on the left hand side here, we've got buying in a limited company from the start. So if you were to buy your properties from the outset and you were to buy them in a company structure, one of the ways that we recommend to our clients and our tax consultants definitely recommend to our clients is that they set up what's called a smart company, or otherwise known as a family investment company. And effectively what you have is you have person A and person B. Person A and person B might be husband and wife, okay, in this example. And then you have all of these other shares, okay, which are like your alphabet shares. So this might be like A shares, B shares, C, D, E, etc., right? And effectively, these shares are held for future gifting by person A, and these shares are held for future gifting by person B. Okay, and again, I'm not going to go into the granular structures of how a smart company structure works. Again, there is another YouTube video on my channel all about smart company structures, so you can go and check that out after watching this video. In this video, I just want to talk about the mechanics of washing out a capital gains tax bill. So I really wanted to talk to you about buying in a limited company from the start, because obviously when you buy in a limited company from the start and you have these freezer shares, you basically freeze the shares on the day of the company setup, you can see that the value of the shares are valued at a penny. And the reason that they're valued at a penny and not zero is because whenever you set up a company, you have to give the shares a nominal value. They have to be given a value. So obviously, the value that we give is 1 pence per share. Now, we typically would break it down into 10,000 shares for the purposes of bloodline and legacy planning. And you may get, I should say, 4,925 shares each, okay? So effectively, maybe husband and wife own 49% of the shares each, making up 98%, and the remaining 150 shares in this example would be effectively 1.5% to 2%, whatever that works out to be, to give you 10,000 shares. So you have 9,850 shares owned by person A and person B, and 150 shares distributed in 10 shares each to the bloodline planning, maybe kids, grandchildren, in-laws, etc., for the purposes of tax efficiency in a property business and a property investment company structure, okay? But the thing to note is that the share value on the day of opening the company is a penny. And therefore, if you take 1 penny and you times it by the number of shares, so 4,925 shares times a penny gives you a share value of £49.25 per share, which basically means the total share value on the day of opening the company with 10,000 shares is only £100. Now, that's the most optimal way that you would set up a property business from the outset. And effectively, if you freeze the shares at the day of setting up the company and the day that is you're incorporating your business effectively, the shares will never ever be worth more than the frozen value. So they'll never ever be worth more than a penny each, okay? Even if the company became worth £100 million or £1 billion. Okay, now incorporation of a privately owned property rental business on the right, just to show you the kind of difference in the comparable. So when you're incorporating a privately owned property rental business, of course, you're introducing your existing property assets that have a value and you're exchanging them for shares. Those properties have to come over into the business and they have to be valued, and they have to come over at the current value at the time of incorporation. Okay, and one of the ways that you would do that is you get a valuation, or I believe from our tax consultants that a home track report is a fair and equitable means of justifying the current value of the properties on the day that you incorporate the properties, and HMRC would substantiate that and deem that to be a fair and reasonable method to give you your current values when you incorporate the properties and bring them over for said value. Okay, now in this example, you can see we've got shares that are valued at a premium. And this is effectively what I mean by about washing out your capital gains tax bill. So let's explain how this works. So let's say that the current value of your properties for a minute was £2 million. So, okay. So you're bringing them into the company at £2 million, and you brought these properties. So your acquisition costs, remember acquisition costs are effectively your base costs, which are your purchase price, plus your purchase costs, stamp duty, land tax, legals, broker fees, whatever you spent buying the property, plus your capital costs over the years on those properties. And let's say that your current value is 2 million, your acquisition cost is 1 million. That means that your current value minus your acquisition cost is, of course, your capital gain value. That's how you calculate the capital gain on your privately owned property portfolio, and the taxman works out how much tax you have to pay in terms of capital gains tax if you were to sell those properties. So in this scenario, look, our capital gain is £1 million. And if we sold these properties in our personal name and we're a lower rate taxpayer, we'd pay 18%, and 18% of the £1 million is 180,000. And if we're a higher rate taxpayer, then the capital gains tax is at 28%. So on the £1 million of capital gain, we pay £280,000 of capital gains tax, if we're dispose of the assets for £2 million against an acquisition and base cost of £1 million. Okay, so hopefully that makes sense and is relatively straightforward so far. Okay, if you've got a privately owned property rental business or in your personal name and you dispose of those assets, you pay capital gains tax, and that's how it's worked out. Now, ultimately, either way, whether you're a lower rate taxpayer or a high rate taxpayer, incorporation still could be a great move for you because you're future proofing. Even if you're 18%, you'll see actually that incorporation and washing out your capital gains tax bill in the right scenario, providing you haven't created a latent gain, is still going to be more often than not very advantageous to you, and it's going to help to minimize and defer your tax liability. Okay, so then if we wash out the capital gains tax bill, so we elect not to sell the properties in our personal name, but instead we decide to sell the privately owned properties from your own name into the company via incorporation, wash out the capital gains tax bill under business incorporation relief, this is what it would look like. Okay, and effectively what you have here is the same scenario. The current value of the properties is £2 million, okay? And your mortgage liabilities on the properties, let's say that it was £1 million, okay? So the net equity in this example is £1 million, okay? So remember, when you're moving properties from your personal name into a company by way of sale and washing out a capital gains tax bill under the legislation that we've talked about, you exchange equity in your properties for shares, okay? And in this scenario, I've made sure that the equity of £1 million is exactly the same as our base cost. Because if our equity was lower than our base cost, let's say it was £600,000, sorry, £600,000 here. If this was lower than our base cost, you would have a differential, but your equity would be 400,000 less than your capital gain. And remember, if your equity is less than your capital gain, then you have a situation where you don't have enough equity to offset the capital gain, and therefore you can't roll that over into the shares. And in this scenario, you would have created a latent gain of £400,000, okay, if your equity was in that scenario, okay? So that's kind of like how that kind of works, just to explain that to you. Where you create that latent gain. And effectively, it's the same thing. If your mortgage liabilities was 600,000, then your net equity is 1.4. Your equity is still bigger than your capital gain. So it's when your mortgage liabilities go above your base cost, like in this example, 1.4, which brings the equity down to 600. That's what I was meant to do in this example, sorry. So if you brought your mortgage liabilities up to 1.4, your equity drops to 600,000, which is the example I just created. You can see that your capital gain is £1 million, your net equity is 600, your equity is £400,000 less than your capital gain, which creates a latent gain. In the same way, you can look at this. If your mortgage liabilities at 1.4, bigger than your base costs, which are £1 million, you create the same scenario where base cost minus mortgage liabilities. If your mortgages are bigger than your base cost, you create the same scenario where you've got £400,000 of a latent gain, and you pay 28% or 18%, depending on whether you're high rate or low rate taxpayer, and you crystallize a capital gains tax bill on the latent gain. Again, because your net equity is less than your capital gain, it works out to be the same sum. Just two different ways to look at it, two different calculations would get you the same number, would mean that you don't have enough equity because it's lower than your capital to roll that over into shares, okay? But let's go back to this being £1 million, because I created it, sorry, £1 million. I created this example so that it was perfect, where your mortgage liability is exactly the same as your base cost. That's the best scenario that you can possibly get for this example when you're washing out a capital gains tax bill, okay? So in this example, privately owned property, we have these capital gains tax values. Now, if we sell it to the company, £2 million, £1 million in mortgages, the net equity is £1 million. We're effectively taking that £1 million equity and we're rolling that into the shares. Look, effectively what we do is we take the £1 million and we divide it by the number of shares held by person A and person B, who are the owner of the shares, okay? We wouldn't do it to the shares that held future gifting. We do it to the owners of the company. So the owners of the company in this scenario, typically speaking, we always set it up in this way, where they get the majority. So 4,925 shares each would mean that you have effectively each share, if you add those up, so you take the million, divide by £9,850, you get your share value of £101, okay? So if the shares are valued at £101, it basically means you've taken this equity and you've rolled that into your shares, okay? And in this example, your share price minus the number of shares held by each person gives you your total share value, which basically means that person A and person B shares are now worth £500,000. Okay, and that creates your million. So you've taken that equity and you've rolled it into the shares. Hopefully you can see how that works. Now, if you freeze the shares on the day that you incorporate, the shares will never ever be worth more than £100. But obviously this is like the secondary thing, because the best thing you could have done is just to buy the properties in the company originally in a smart company and froze the shares at a penny. But you didn't. You're doing the next best thing, which is to incorporate the properties to wash out the capital gains tax bill, in which case your shares get valued at a premium. You exchange the equity for cost of shares. Now, in this scenario, look, if the cost of shares are effectively £101 each, and you have £500,000, well, if you were to dispose, person A was to dispose their shares and person B was to dispose their shares. So if you disposed all of the shares, and all of the shares, this is the most important thing. Remember, you don't pay capital gains tax bill in a company on disposal of the properties. You pay it on the disposal of the shares now when you're washing out the gain. So if these person A and person B were to gift all of these shares or transfer their shares, for a better term, to any of their bloodline, maybe their kids, and they were to transfer all of those, they'd be exchanging this capital gains tax bill of £180,000 or more likely £280,000 as high rate taxpayers in exchange for either a 10% capital gains tax bill or a 20% capital gains tax bill. Because remember, the capital gains tax on shares is lower than the capital gains tax bill on a property. So that's the advantage of washing out the capital gain and rolling the equity over into shares, is you actually get a reduction on capital gain. Okay, you can see the capital gains tax value here, if all of these people that they are passing their shares onto were lower rate taxpayers, they'd pay 10%, and obviously if they're high rate taxpayers, they pay 20%. So you've got 180 versus 100 and 200 versus 280. So you can see the transfer of shares and disposal of shares and paying capital gains tax on the share value is still cheaper than if we did the same thing and sold the properties in our personal name. But the best thing about this is you wouldn't obviously dispose your shares all at once. What most people would do is choose to defer that tax bill, because you're not paying the tax. If you sold the properties, you don't pay tax, remember. You only pay on disposal of shares. I can't make that any more clear, and it's really important. I keep repeating myself because it's the most important thing. You're deferring your tax. You're not getting rid of your tax. You're reducing your tax. You're washing it out, but you're deferring it against legitimate tax planning, as we've seen from HMRC manuals, which I read at the start of this video, okay, to you from the website directly. So you're basically deferring and controlling your tax. Because what you could do, look, is every single year for, let's say, 40 years, I ran an example of 40 years, you decided to distribute these 4,925 shares, right? Well, 4,925 divided by 40 will give you 123 shares every year that you gift or transfer to any of your bloodline. Now, if you distributed 123 shares, right, and each share was worth £101, and you had to pay 10% capital gains tax on that disposal because the person that you're transferring to was a lower rate taxpayer, you're only going to pay £1,248 to transfer 123 shares every single year for 40 years. It's much better than having to pay £100,000 at once, for example, right? In that scenario, or half of £100,000, which would be the £50,000, okay? Let's say, for example, you gifted some at 10 and some at 20% over the 40 years. I've said, well, if you had to gift those shares at 15% and you gifted 123 shares a year for the next 40 years of the 4,925 that you own as an individual up here, at 15%, then the average would be that you pay £1,873 a year in capital gains tax to transfer those shares. And if you had to dispose and transfer all of the shares, worst case, everybody was a high rate taxpayer that you're gifting the shares to. If you'd done 123 shares at the 20%, you'd still only pay £2,497 a year for 40 years, okay, on that specific set of 4,925 being disposed over the 40 years. And that's good because as an owner of the business in this way, typically speaking, most of the time people set up a family investment company is that they want to actually give their shares to their children eventually, because unfortunately we're all going to die, and on our demise we probably want to pass it on to our loved ones, our beneficiaries, heirs, and most of the time that's our children as the first point of call if we have them. And so this is what this example represents and alludes to. You're effectively controlling the tax bill and having much better control over when you pay those taxes and how much tax you pay. So it's a very nice flexible structure. So hopefully this explains to you exactly how you wash out the capital gains tax bill, exactly some of the calculations and methodologies that we go through to work out how much tax one should pay. And you can see how advantageous it is if you do have a capital gains tax bill in your own name. I'm always saying to my clients, hey, if you've got a capital gains tax bill and you qualify for incorporation, why would you sell the properties and pay the capital gains tax bill? If you wanted to sell and dispose of the properties anyway, why not transfer them into the company, exchange the net equity for shares, and then dispose of the assets, because you're not going to pay any capital gains tax bill when you dispose of those assets. You're only going to pay it when you dispose of the shares, so you can defer the tax bill with the benefits I've alluded to. And effectively, one could say that if you just chose to do it all at once at a later point, then actually the person that's taking the capital gains tax bill are your beneficiaries anyway. It depends how you look at that, favourable or unfavourable, depending on what sort of individual you are, no right or wrong. But I'm sure you can appreciate as to why. But it's obviously a much better way. So hopefully that explains it for you. Let's go back in. I'll just conclude and wrap up, and I'll talk about what situations, to finish off the video, what situations would you not pay capital gains tax on disposal of shares? There's only one, and then I'll just dive into more about the latent gain, clarify that, and wrap up.
Now that we've looked at the spreadsheet, I hope that brought a lot of clarity to you and helped you to understand the mechanisms and the actual calculations and the true mechanics of how you wash out a capital gains tax bill if you're moving properties from your privately owned name and incorporating them into a limited company. Now, one of the biggest questions that I also get asked, you might be thinking, is, well, what scenario would mean that I never have to pay the capital gains if I dispose of the shares? Well, the only way that you would never have to pay the capital gains on a share disposal is if you were to die prior to disposing of those shares. It's a pretty tragic way and a pretty onerous way to think about saving tax, but factually that's really one of the only ways that I know that you could not pay or not trigger a capital gains tax bill on disposal of the shares, is if you were to die before you disposed of those shares. Of course, in that scenario though, your beneficiaries would have to pay the inheritance tax on those shares if they were gifted those shares and you were above the nil rate allowance of 325 per person, 650 as a married couple, then inheritance tax would be due. So you are paying some tax, but you're just not paying the capital gains tax on the disposal of the shares if you were to die. Okay. Now, the other thing is to note again, just remember that if you have a latent gain in your property portfolio, you cannot wash out the capital gains tax bill. Remember, if your net equity is less than your capital gain, you have a latent gain, and therefore it basically means that your mortgage liability is higher than your capital base cost on incorporation, which basically means the same thing in real terms, and effectively you crystallize a tax bill, a capital gains tax bill on the latent gain value. So that's just something that you need to take away. And remember, if you're watching this video, to think about when you're looking at your own subjective individual parameters about whether incorporation is right for you and whether realistically you could wash out the capital gains within your portfolio. However, with that being said, even if you have a latent gain, there are various ways to deal with a latent gain. And within our business, propertyconsulting.io, and the widespread team under the umbrella outsourcing to chartered accountants. I do own an accountancy practice. I work with a chartered accountant, outsourcing the work to the relevant barristers, lawyers, and tax consultants. We can help you understand and suggest ways that you could potentially solve your latent gain problem. So if that's something that you're unsure about, you should get bespoke, nuanced advice. And that's one of the things that my company, propertyconsulting.io, helps with. Like I said, I can give you an understanding. I can demonstrate my knowledge, my opinions, having looked at hundreds and hundreds of property portfolios that have been incorporated, having worked with excellent tax consultants, chartered accountants, and tax barristers over the last 4 to 5 years. Understanding all this stuff, I can give you ideas about what you can do, and we can refer you off to the relevant people, and we kind of piece it all together. Because when you incorporate your property portfolio into a company, of course, that's just the first stage. Most people that we work with under our brand propertyconsulting.io, most of my high net worth clients, or even my property investors that are just incorporating even 2 or 3 properties potentially, they still want to look at the future growth and work out what's the best way to scale and optimize the property portfolio after incorporation. And we look at the whole thing together as a team with the relevant professionals. So if that's something that you're interested in, you can click the link below. You can book in a course, schedule a consultation, initial consultation free of charge with my team. We can take a look at your situation. We can talk about how we may or may not be able to help you. We'll be very honest with you. We're very transparent. If we can help you, we'll tell you. If we can't, equally, we'll tell you why we can't help you as well, and send you to somebody who might be able to help and serve you better, because that's what integrity is, and that's what we stand for. And that's my number one value in business, is honesty, integrity, and always doing what's best for our clients. Okay, so hopefully you enjoyed the video. If you did, please go ahead and give it a massive like. It would really help us to get the YouTube algorithm working in our favor and share our content, and I really appreciate it. And if you haven't already and you're new to my channel, please make sure you go ahead and subscribe, and make sure you click that bell icon so you can be notified of any new content coming up. Thank you so much for watching. I hope you found it useful. If you've got any other questions about incorporation or washing out capital gains tax on your privately owned property rental business, again, feel free to drop those in the comment section below as well. Myself or somebody from my team will go in and answer those for you. All right, have a great week. Take care. See you in the next one.